Bonds and equities have been on a long rally, and although the VIX, a measure of the market volatility, has climbed near 20 in the past days, it is still reasonably low in historical context. Some argue the market is ripe for a correction.
There are investors that are complacent, but there are investors that are skeptical also. And the evidence we get from position indicators we track is rather mixed. For example, our client survey, which tracks the duration exposure of different types of clients, shows that while single currency investors were pretty long duration ahead of last week's ECB meeting, multi-currency investors had rather low duration exposure. And that is a different picture from a year ago, at the beginning of 2015, ahead of the Bund Warsaw, when both types of investors had pretty high duration exposure. The Warsaws we experienced in the past, like the Bund Warsaw in April 2015, were underpinned by three conditions: low volatility, overstretched position, and overstretched valuations. And not all these conditions are currently in place. Even in the vol space, rate vol deliver volatility in rates was not as low as deliver equity vol ahead of last week's ECB meeting. For example, in this chart here, you can see that systematic hedge funds, risk parity funds they base their strategies on volatility, and CTAs, commodity trade advisors, that they trade based on trades on different markets, are heavy in terms of their equity exposure. This is the implied equity exposure we derive by looking at the relationship between their performance and the performance of the equity market. And that suggests that ahead of last week's ECB meeting, just before the correction began, we had some sort of vulnerability from these two types of investors. However, there are other types of hedge funds that did the opposite. You can see here two other types of hedge funds: equity long short and discretionary macro hedge funds. They appear to have reduced their equity exposure ahead of last week's ECB meeting, and especially discretionary macro hedge funds had a rather low equity exposure. That mixed evidence to me suggests that we are unlikely to see this mini tantrum we saw at the end of last week cascading, if you want, into a bigger Warsaw.
Dust off your vinyl, Dark Side of the Moon, Exile on Main Street, maybe even Never Mind the Bollocks, because the world is heading right back to the 70s.